Hello, this is Dr. Alex Moseley, founder of the Economic Circle. In this third installment on money and the economic principles around it, we're going to look at the problems that banking can create. Now, remember from the Origins of Money video, my first video on this, that money evolves through commercial activities. It is not invented. This is absolutely critical for economists as well as historians, archaeologists even, who create stories about what may have happened in the past, to understand is the principle of monetary emergence that comes from the market is absolutely vital for us to understand should we wish to understand why we have monetary problems in the 20th century and 21st century today. Second principle, traders are always keen to cut the costs of exchange, and the market, that is other entrepreneurs, other traders, will offer services to facilitate trading between goods and services. Banking emerged to offer two distinctive services. Deposit banking, you leave your money with the bank and maybe draw upon it with checks or these days electronic trading, or investment banking. Now, we're going to have a look at when deposit bankers cheat. Economic problems begin with the deposit bankers lending out money that's not theirs to lend out. You can't do this, right? This is immoral and illegal usually. Let's follow this. When you deposit family valuables into a secure deposit, such as a safe, the nature of those valuables, they're typically unique, means that the storage company, let's call it, cannot remove the objects for their own use without you finding out at some point, especially if they lose it, right? For instance, the storage company may lend out jewellery for weddings or parties and earn a return on them without you knowing. But sooner or later, we hope that such fraud would be unmasked. And as I say, if it goes missing and you go to claim it, the storage company is in trouble, reputation gone, goes bankrupt, people go to jail. Now, such breaches of contract have happened and still happen, but the law was and always is on the side of the depositor. However, we have a different issue for some reason when it comes to money, or so-called fungible assets. Fungible assets are anything that are indistinguishable from each other. So monetary commodities, coins for example, in this, such as gold and silver, are practically indistinguishable, except for numismatic purposes. You know, oh, this coin is from 1172 and this one's 1234. They're both gold, same weight, but numismatically, in terms of studying the coins, there is a difference. But from an economic point of view, they're both an ounce of gold, let's say. And this fungibility, great word, enabled banks from a very early period to cheat much more easily than lending out the family jewels that you've put into their safe, because money itself, hardcore commodity money, is fungible. So in other words, like rice or wheat, it can be deposited into the same safe, and it does not matter which coins or weights are pulled out by the depositors. So imagine a banker accepting equal weights of gold from many depositors and charging a small fee, which is fair enough, for secure storage and for transaction services such as checking, note issuance, etc. And you come into the bank to withdraw some funds. The bank releases funds from your account. In other words, the actual physical coins of silver and gold are indistinguishable from any other clients, and it doesn't matter which coins you take out. It doesn't matter if they're exactly the same ones you put in, unless you specifically indicated, I want these coins from 1137 and the Roman period and the Greek period to be put in the safe because they're numismatically different from everything else. They're non-fungible. But if we're talking about regular coins or regular bars or ounces of gold or of silver, it's indistinguishable, and that fungibility is readily acceptable by the markets, and it doesn't matter which coins you get back. So far, no problemo. Okay? But the first temptation to cheat is for bankers to use deposits for their own investment purposes. Say with £1 million held in account on the bank's accounts, on average through the year, the money is just sitting there from the banker's point of view. It's just sitting there. Look at it. It's nice and glistening, and nobody claims it every single day. Now, the depositors are assuming that this is exactly what their money is doing and will continue to do, that it will just sit there because that's what a deposit bank's all about. It's a deposit bank. Now, their contract with the bank is to deposit their funds so they can withdraw on demand through checks, direct debits, standing orders, point of sale transactions, etc., direct debits, whatever, to pay the bank's for the deposit and clearing service. Simple. But the banker is sitting there with all that gold and silver thinking, I could use some of those funds. I could lend the monies out to some businesses in the locality and other people and charge interest for the service. After all, it's not doing anything, might as well earn some money for me. In other words, the deposit banker sees an opportunity to become an investment banker or broker. But he has not attracted lenders' funds to his project. He is looking upon the monies as he would the jewellery in the safe as stuff to lend to a wedding and party guests for an evening and charge them. It's a breach of contract. He has neither the owner's consent nor the market's. That is, he is presuming control over the deposits, well, nobody's using them, might as well use them for myself, that he does not have, for he is not an investment banker, and he's not earned the right to be an investment broker through the building up of trust among the lenders. He acts, though, as if he has gained those funds legitimately. So somebody comes to him for a loan and says, yes, I'm sure I will lend you 10,000 at 6% interest per annum with just filling these pieces of paper. And nobody asks, where did you get the money from? Well, it's just sitting here, isn't it, doing nothing. Well, that's what it's in a deposit bank supposed to do. Now, some economists may argue that this is acceptable, as the borrowers, the lenders, and the depositors all benefit from the bank secretly lending out funds. What harm can occur, say some apologists for deposit bankers acting as investment bankers? For one, if the contract is for deposit services, like putting money in a safe, the contract has been broken. Legal problem. If the banker wishes to enter the investment profession, he needs to draw up a new contract with clients that stipulates that their deposits are now investment funds, and as we all know from adverts, etc., the value of investments can go up as well as down. So you might not want to put your money into a fund that goes up and down when you expect to pay your rent with it in the following month. Secondly, focus on the last comment. If the banker's investments fail, he has lost depositors' funds which he had no right to be using in the first place. So it's not always the case that the borrowers, the lenders, and the depositors will all benefit if the banker screws up. Indeed, the incentive for such an unscrupulous banker is not to be as thorough as an investment banker would be, who has earned the trust of lenders and borrowers in the marketplace through his professional behaviour. Our fraudulent banker is more likely to lend to enterprises that are going to fail. Right? Historically, this was often the cause of the depositors uncovering the scam of exploiting depositors' funds. Where's my money? Well, you see, it's sort of been lent out to Joe. You know Joe around the corner, and he's paying 6% interest on the return. So therefore, you know, I can offer you a cheaper deposit rate. Really, you don't have to pay the 10% per year on your account. You could pay 5%. It's very good. Joe's business has just gone under. Where's my money? It's well, you know, it's let me just go to the back and see if I can sort something else out for you. You mean somebody else's funds? I think I need to call the police on this one. And that's the kind of thing that's gone on in banking history, when bankers sitting on deposits, safeguarding them, have looked at it and thought, yeah, I think I could earn some interest on this. That's wrong. Absolutely. Right. Any economic effects so far? Well, not in terms of inflationary or deflationary effects. We will come to that in another unit. But in terms of fraud, oh yes. Funds have been illegally shifted from owners to the bankers. The bankers have taken ownership, control, and management of funds to which they had no right. Economically, we argue that this represents a distribution of resources from the productive classes to the criminal class, because after all, the bankers are acting criminally in this regard and have been chased out of town and executed in ancient times for doing this. Now, historically, lawyers in various countries have attempted to defend the bankers' actions,
But you see, my lord, you see, when the deposit comes in, really, the client doesn't want to take it all at once, so he's given it over to the bank, and therefore the bank may, my lord, lend out the money as it sees fit. Yes, I see that, but was there a contract for this at the very beginning? No, not quite, but you see, my client, the banker, thought he could earn some money on the side. I see. So the banker used money to which he had no right for his own profits. You're telling me this? Well, you see, my client thought he'd be doing the community a lot of good, service, public welfare and all that, by borrowing the funds, putting it through investment circles and, helping economic growth, paying taxes and that sort of stuff. I see. So you're telling me your client stole money, used it for his own profit. There is a word for this. It's called theft. Theft is, after all, theft. It is. Now, in the next lesson, we'll expand on the effects of issuing false claims. Thanks for listening, guys, and don't forget the Economic Circle as a magazine is available. I publish it and edit it with external contributors on Apple Newsstand and Google+.